Okay, hello everybody and welcome to the MarketSmith Advanced webinar. Today we are going to talk about the Shakeout Plus 3 concept. First, a quick introduction. My name is Arusha Piras. I'm one of the product coaches here at MarketSmith, and with me today is Jason Thompson, a fellow colleague and product coach at MarketSmith. Today's agenda. So we'll first start out with the Shakeout Plus 3 concept and just go over what it is and what we're looking for. Then we'll go over a few examples to illustrate the concepts, and then finally we will show you how to use the trendline price alerts in MarketSmith to give you a heads up on some of these stocks that are potentially setting up this Shakeout Plus 3 concept right here. Okay, let's make sure we have all the software functionality underway here. In the top right-hand side, you're going to see a little panel right there. It's going to allow you to ask us a question. Use this little field, type in your question, and we will answer it by the end of the presentation. I hope everyone hears me how to trade in stocks book. And the reason why we're talking about it here is because we believe that the more entry points, the more base patterns that you know and you're aware of, the more choices you're going to have and the more flexibility you have. Now, this is more of an advanced strategy, so we want to make sure we're clear on that. It's more an aggressive point, and a lot of times we will go in a little bit smaller for this, okay? Because a lot of times what's going to happen is if you try to cheat into one of these stocks, instead of waiting for the standard buy point, you're just setting yourself up to be whipped around more. And I'm sure a number of us have experienced that. I know I have. But the reason why with the Shakeout Plus 3, why we like it is, and why we try to go for it sometimes in the right stocks, is because it potentially allows you to get a lower average cost when the stock that actually has a chance of working pretty quickly after the Shakeout Plus 3 buy point. Now, really the one key thing here is the reason why this is so important is because this comes right after a point where institutions try to shake the tree. They're going to try to shake us out. Jason, you want to talk a little bit more about this?
Yeah, definitely, Arusha. Thanks. So when we often hear the concept a lot of the times is that institutions try to shake the tree. Well, what that really means is if we think about an institution, some of the larger ones, it takes them several months or even longer to fill out some of their positions, even just a normal 2 to 3% position of the fund that they're trying to, or the stock they're trying to accumulate, and they can't just go out there and buy it every single day, right? So when the stock comes in and they start to get near their ideal purchasing PowerPoint or anything like that, they're going to try to scoop up a couple shares in order to, one, support their stock, gauge the demand for the position, and two, just to try to fill out their remaining position of the stock.
Okay, thanks, Jason. So let's go further into this. And so here, this is a little chart right here to illustrate the concept. It's going to look very familiar to a double bottom, but it will give you a little bit of an earlier entry point for the most part. And so quite simply, just get this concept down. You're going to have a stock that's in a nice uptrend. It creates a first low. Now it bounces off that first low, and now it comes back down and tests that original low. And so this is where the institutions are going to try to shake the tree. It undercuts, right? So you finally break through that support area. And so this is the critical area. And this is where the institutions are going to reveal their cards. Or do they really want this stock? Because ideally what you want to see is the stock come back pretty quickly after undercutting that first low, indicating that funds are there buying up these shares at this point. There is demand here. There really is true support. Really, you're just getting a pretty massive shakeout. And so that's what we're looking for. And then finally, once it comes up a certain amount from the Shakeout Plus 3 low, from the original low, that's where we will have our Shakeout Plus 3 entry point. So we will show this in a number of examples here. But the key is that we want it to go up a certain amount above that first low on big volume. Okay, so yeah, Nicholas, it looks like you mentioned here, it does look like it all. A lot of times we are going to see it's going to be the same thing, except the Shakeout Plus 3 will enable us to get a few shares a little bit earlier. It's not like we're going to go in and buy all of our shares at this point, but it may enable us to get a little bit to get some feedback. Okay, so it is an aggressive buy point, and so you want to always go smaller in a more aggressive buy point. And of course, this also requires you to be more experienced at this, okay? Because if it doesn't work, you have to be quick to cut and run. You have to be quicker than out of a normal base, okay? So just keep that in mind. And so now when Jesse Livermore talked about this Shakeout Plus 3 concept back in the day, a lot of stocks were $30. Obviously, as we know now, there are way more stocks over $30, and so you can adjust this shakeout plus three concept. So pretty much, and this is not an exact formula, but if you're around $60, yeah, you're going to probably want to add 6 points to that first low. If you're at $90 stock, you're dealing $90 stock, around 9 points. Okay, so it's usually around 10% or so. I've heard Bill O'Neill address this kind of question of shakeout plus three. He never really confirmed that. Okay, yeah, it's definitely 10%. You always want to look at the chart, see a resistance area. We'll show that in one of the examples with, I think it's CME, where you want to take into account the resistance area too, and sometimes they all line up. So let's go into the first example. So Jason, let's go through Ambarella, and why don't you take us through this?
All right, Arusha, thanks for that. So the first couple of stocks that we're going to look at are going to be the more traditional double bottom approach to that. And one of the last examples will be a little bit different, more practical and a shaky market in that. So the first stock here is Ambarella, and this is where we're going to go over the Shakeout plus 3. As we know, it was one of the leading semiconductors specializing in the sports cameras and broadcast infrastructures, and they do a lot of the wearable cameras. It was an interesting IPO as a lead underwriter by Morgan Stanley, and what we see here is that it built a nice IPO base. It went up like a rocket ship, just from $6 all the way to $20. And if we miss the stock, and the odds are if we don't get in the first stock or the first stage base in that's okay. But what's not okay is missing the stock going on for another big run. And as we know, most base patterns tend to correct when the market corrects as well. So this stock should definitely have been on a radar, been on our watch list. And what we're looking for is just to observe it. It's not necessarily going to be on a buy list right away, but let's just see what it can do as it's building a base pattern while the market is correcting, or it's just taking time to rest, really. So what we see here is a first low being put in an Ambarella. It undercut its 10-week moving average. The character or behavior of the stock is changing slightly. And what we're looking for now is a test of the first lows or a retest of the prior support level. The main important factor here is we want to see an undercut of the first low. And oftentimes is when we see an undercut of the first low, what it's doing is we're getting out of a lot of the weak shareholders, because on the first low point of the stock, there's a lot of support. A lot of investors put their stop losses in place, and they'll get triggered or they'll get alerted when there's an undercut in it. So technically speaking, right now, this does not look like a very good chart pattern, but what we're starting to see is that a second low is being formed, and there is support for those higher prices, gauging by the volume on the right side of the base. So now we can kind of see, okay, this looks like a double bottom forming. Can we get above the first low and really prove to us that this stock is going to continue in an uptrending pattern? And we see here, this would be our Shakeout plus 3 buy point. All we did is we took the first low, which was $15.54. We adjusted 2 points to it, and this gave us our $17.54 buy point. As you can see on the right side of the base, there was huge volume confirming for those higher prices. And if we compare the Shakeout plus 3 buy point to a normal standard buy point, we could see it's going to get us in right around the 10-week moving average. It's going to allow us to obtain our average cost slightly lower. And we have to remember, since this is the Shakeout plus 3, it is a more advanced buy point, a non-traditional approach, we want to adjust our risk accordingly. So we're not going out there and just buying an entire position. We're going to start out buying a position. We want to be actively engaged in it. We want to be more concerned towards the right side. If it does goes higher, we can continue to add, just like our normal positions out there. And really, what oftentimes are, and we see about actually 50% of all times when stocks break out of their pivot ranges, they retest their pivot ranges. Go back in Bill O'Neill's book and we could read that. And you'll see it here. Ambarella tested its pivot range not once, but twice, really before it started to take off and go on its big price advance. So if we do get a Shakeout plus 3 chart pattern or buy point, it's going to allow us to get a lower average cost, so we could really sit and capture the stock's move or its full potential of the stock.
Okay, looks like we have a question here from Janet here, just to make sure we're clear on just what a shakeout is. You remember, so you have this first low right here at 1554. It comes up and then it undercuts that. Now in the end, it comes back through. So really, what this turns out to be is a shakeout. Okay, so you're just getting rid of all these people. They've set their stops right below the low right here because, hey, guess what? They probably think that the stock is going lower. You're starting a downtrend at this point. Now, a lot of times what will happen is this comes out to earnings, new information comes out, people are suddenly happy to buy it again. And so in the end, it turns to be a shakeout. This is a little bit of a long, a few week shakeout. You also have smaller shakeouts. You can see a little bit of shakeout here. So it's any kind of trap where they're trying to get you out of the shares. So that's pretty much as simple as I can make it. You're getting shaken out of your shares. Okay, so institutions are notorious for this. They never have enough shares, and so they're going to try to knock the stock price down to force us to make us get stopped out of our shares. So let's go to the next example here. This is Netflix. And so remember, starting from the concept itself, here's a stock that was really starting its streaming run. It broke out at 60 here. It went over 100%. And now the stock is taking some time off. And so here comes Netflix. It goes down, gets a first low at the and finds support at the 50-day. Now and retraces. So it gets a nice little bounce. Probably comes halfway from that initial kind of sell-off, and then you run into earnings. Huge volume coming back, and so here's the test of the low. So this is the problem. Here's where you're going to start testing the lows and see and really get information. Hey, is the stock starting a downtrend, or is this a shakeout? You don't have to do anything at this point, right? That's the nice thing about it. You can kind of sit on the sidelines and really let the stock prove itself again before you get into this. Now, a lot of times this is going to happen when the market is bad, and I know for a fact the market was bad at this point because I was watching the stock very closely. So here comes the stock testing the first low. It undercuts. So now you started that downtrend. So at this point, I think we can all agree that, yeah, this stock looks terrible at this time. But remember, we're looking first from the fundamental point saying, hey, they still have a great story. We don't want to necessarily be in the stock, but you don't want to take it off your watch list too. And so a lot of times this is where, and Jason will go over this near the end of the presentation, you may draw a little alert here saying, hey, if it gets back above this first low, let me know. Because now maybe the stock may be changing character, maybe it's getting strength. But at this time, as it's undercutting, you're staying far away from it. This is dangerous. The stock is starting a downtrend. We never know how bad it can get. It gets a little worse, and then suddenly you start seeing a rebound in the stock. And so the stock comes back up. Now it's gotten through that first low. So this is where we're starting to watch and say, okay, Netflix is starting to show a little bit of strength here. Is this still maybe just a kind of a bounce, a low volume bounce back up to resistance area and then sell off again, or not? So we haven't gotten that confirmation yet, but we're getting closer to that potential shakeout plus 3 area. Now, this is what you're looking for. Huge volume, and it's coming through the 50, right? So now everything's kind of changing. The initial assessment where maybe Netflix is in trouble, it's in a downtrend, you want to stay far away. Now you're starting to see evidence that maybe there are funds here who still want to keep buying this stock. Take a look at that volume. The funds are revealing their cards at this point. And so you want to pay close attention to this. Okay, so now if you're more aggressive, and so really I think the only scenario, because what was going on at this point, this was August 6th of 2010. What was going on is we were in a pretty tough correction during this time, and it was very dangerous. A lot of stocks were getting hit. But here's Netflix trying to fight the trend. And so now if you were up huge on Netflix, and maybe say you bought it on that $60, you sold up around 120, you locked yourself in for a 90% gain or whatever, right? You have a good amount to play with here. Guess what? You've earned the right to probably play around with this shakeout plus 3 in a bad market. For a lot of other people who weren't up that much, now you're playing more with fire here, okay? Because you have it's not at that standard buy point, but you're in a bad market. Okay, so this is really for the more experienced, aggressive traders who are having a pretty good year. But you are crossing that shakeout plus 3. So we use $9 at this point, and so that's why it's like, it's kind of a rough estimate. You could use $9, $10, and so that's what gave the 112.27. Notice how it kind of just got back in and kind of reversed that huge sell-off right there. So got back in here. It's telling, okay, Netflix is starting to act a little bit better. Still a bad market. Comes back in, and I clearly remember this day right here, because in the morning the market started off terrible. it was we were probably down 1% or 2 on the futures, and Netflix was gapping down too. And it gapped right down to the 50 and right around that Shakeout plus 3. And then within 5-10 minutes, you saw this surge coming to the stock. And all of a sudden it's like, wow, what is going on here? In this terrible day, here's Netflix, the first stock to go green on that day. And it didn't stop. It just rocketed through, went right through the standard buy point too. So that was another clue that, okay, funds, they don't have enough of this. Okay, so Jenna, it looks like here you're having a question about how you calculate the plus 3 point. We're really using that low right here, 103.27. So yeah, that first low, and so you're using generally around 10%. Well, just give or take. In this instance, use $9. You know what? If you want to use $10 and add to that low, that's fine too. So that's where we used $9 in this case and got that 112.27 point. But it's around 10% of the stock price. There isn't a perfect kind of it's never been really kind of set, right? It's always just kind of been general. So here it comes through, showing a lot of power. Take a look at the volume. So everything's lining up, saying, yeah, this is a strong stock at this point. Glenn asked, are Shakeout plus 3s always double bottom candidates? I don't know if it's always, but for the vast majority, yeah, because a lot of times what you're going to have, if you have a shakeout and the stock is strong enough to come through, it happens in a volatile market, and a lot of times double bottoms are formed also in a volatile market. So they all kind of line up together, and so yeah, you will see it for the most part, especially for the stocks we look for, because we want, in the end, it's going to form some kind of base. Now, there are probably some examples out there that it ended up being a flat base or something like that. But I think for the most part, yeah, double bottoms. I think for all the examples that we've seen, or for the majority of them, they're double bottoms. That's a good question, though. Okay, so then here comes Netflix. It comes through. This is all in a bad market. So Netflix tried to go like 3 weeks before the fall through day, and it came all the way back down. So this is where it makes it really tough. This is why you're setting up the whipsawing, setting yourself up to get whipped around and stuff like that. And then once the market came around, of course, Netflix was one of the first stocks to lead. It was one of the leading stocks during that market, and it ended up going on this huge run. Now, this was not an easy run to hold on to, stock to hold on to during this whole time, but really came down to the point where, hey, if you buy right, and if you're able to get a little bit of shares in before at that Shakeout plus 3, you may have a little bit better chance of holding through this volatility. And especially once you're able to kind of get through, and let me go back to that other slide right here. When you're getting kind of this pullback down to 120, if you had a few shares down at that 50, maybe it's lowering your average cost a little bit, so you're still not negative at the position. And so in the end, if you're patient at this, then you had a chance. Maybe you get your 15-20%. That's okay too. But this ends up going up to $300 in a very kind of choppy ride. So let's go to the next example here, Jason.
Okay, great. So another leading stock at its time, was at least in 2013, was VipShops Holdings. As we do know, it was an online Chinese retailer with enormous sales. I guess we weren't the only ones understanding that. Wall Street picked up on that fairly quickly because the stock went from $6 to $35, and a really nice move contained its 10-week moving average very well there. So if we miss the stock from its earlier stage base, again from the previous example like Umbrella, that's okay, but to illustrate the point, what's not okay is missing on these big winning stocks again on their second or third run, and etc. So what we see here in VIPs is it should be on all of our watch lists. If it can come in with the market and build a nice base, we want to be able to take advantage of that, especially with reading charts. Now I see a lot of questions coming in here. Are these daily and weekly charts? A lot of the double bottom formations we're going to evaluate on a weekly basis. But a lot of times the Shakeout plus 3 can be very vicious, and it can happen very quickly. So we want to look at the daily chart just to confirm our action of everything in the stock, and really just to gauge the demand for the volume for the previous week. So what we see here in VIPs is that you have a first low of the base, and we want to see if we could get a test or retest of the first low, so we could shake out any of the remaining shareholders that replace their stops there, or if the institutions are just trying to scoop up the shares at a lower average cost, we want to see if there's support in this stock. And if we do see support, we want to know at what level. So we see a test of the first low here. We get a nice undercut, And this is where your shakeout is occurring, is during this undercut, Janin. And then when we get the undercut of the first base in that, technically speaking, this does not look very good. The stock went from $38 all the way to $25 here in just a couple short weeks. So technically speaking, it's not very constructive. It's not very sound yet. We want to keep in our mind, okay, when we do get an undercut of the first low, this starts to look like a double bottom formation. So let's be even more engaged in the stock. Let's look at it. Let's see if we could get a rise above the first low, which is at $27 mark there, and high volume. So what we see here is that it does get above that first low. It does confirm there's more demand for those higher prices by the volume increase. It looks like on the right side of the base, you have about a week of straight, steady buying volume there. And how we calculated our shakeout plus 3 buy point, see a couple questions on that, is that we took the first low of the base, which was $27.10. We simply added roughly 3 points to it. That's going to give us our $30 buy point. And if we compare it to a normal, traditional standard buy point of $33, plus it's going to lower our average cost about 3 to 4 points lower, and it's going to get us in right about the 10-week moving average. We want to do this, one, not to get in the stock early and carry a lot of risk in it. We want to understand there's more risk, but we want to really just capture the stock's full move. So we're trying to be engaged in the stock. We're just buying a little bit at the shakeout plus 3 buy point, and if it continues to work, then we'll add to the position. And you still have an opportunity to buy a lot of these stocks. If you miss them early on in the more aggressive buy points, like the shakeout plus 3, you'll get sometimes a chance to buy them again at the standard buy points. And one of the reasons that the shakeout plus 3 buy point, it's so good to understand, it's one, it's going to give you another opportunity to buy a stock, and two, it's going to really allow you to feel less pressure in the stock. Scott O'Neill likes to say, park the sub on the bottom for when the stock comes back in. VIPS, we know, is very volatile stock. It went from $33 to $50 in a couple weeks, but it also came right back down to that $40 level really quickly. And if you have that shakeout plus 3 buy point, if you are buying the stock just a little bit early to obtain the lower average cost, you're going to feel less pressure when it comes back in here. And as we can see, VIPS is still going from those buy points in that. So it's really good to understand what the shakeout plus 3 is. And if we miss it on the first run of the base or the second run, that's okay. But let's really try to capture the stock again if they correct with the market with that, so we can be prepared for the next opportunity that occurs.
Okay, so let's go into one more example here. And here's a CME group back in 2005. And as you can see here, it broke out of a cup with handle, went on a nice run, coming back in, right? So at this point, we have no idea if it's gone on a great run. Nothing for CME to be ashamed of at this point. It went on a great run, and it could be over at this point, right? So you're not going to try it at this time. But the reason why we use this example, because it's not nearly as clean as some of the other examples here. And as hopefully you guys can see this is an absolute mess at this point. But really, what's the most important thing is just get the concept down. Here's CME that eventually put in that first low, kind of chopped its way higher, and now here it comes back to test the second low. Now here's the key. We're going to get information on it. How does it react to the second low? Does it sell off and go much lower, and it's the beginning of a downtrend, and is this move forever done? Or is it eventually, over the next month or so, going to start finding some support from the institutions? And in the end, it's just some really ugly, vicious shakeout. And so it's nice to kind of sit on the sidelines and take a look and say, hey, here is a leading stock, or was a leading stock, and maybe now it's just running into some trouble. Hey, can it get going again? Kind of like what Netflix did in the past. So testing the low, high volume. So at this point, technically, it's not looking very good for the stock. You're staying far away from it. It's coming back. Now it's really undercutting. Notice how it bounced back up. So undercut, came right back up, and then it didn't have, there were hardly any buyers here. And it came back, and take a look at the volume coming in again and undercutting. So it's really now getting a little bit worse here. And it gets even worse, right? So at this point, we're not really trying it until this day, where we're not trying it at this point, but we're saying, wait a minute. You know, it started this downtrend. It could have gone really worse, but hey, look at all this volume coming in, and now it's gone past that low again, that initial low. And so this is the point where it's saying, okay, If we really like the stock, maybe we made some money on that initial run, where do we start getting back into it again? Maybe start buying. Sometimes you may even just use a pilot position. Just a lot of times, a lot of leading stocks will get hurt and they'll start getting hit in a bad market. And so you really don't want to be kind of going head first into any of this stuff. And you're definitely not buying all your shares out of Shakeout plus 3 buy point. But here you're noticing and saying, hey, there's big volume here. Let's try to figure out the Shakeout plus 3 buy point. You're using that 183.50 level. And we're using around 10%. So we're adding $18 to it. So 183, that was that initial low, plus 18 gives us 201.50. Okay, and notice how this kind of lines up with this whole little resistance area here too. So this is where it gets kind of tricky for this whole Shakeout plus 3, because remember, you are buying within a base. The standard kind of buy point of this kind of huge double bottom would be up here at 220. So you're want to try to sneak in and get a few shares at this point. You're setting yourself up to get potentially whipped around a little bit. And right here, it kind of snuck above that 201.50 and then sold off. So this is why we're saying that this is more aggressive, and it really requires experience at it, because if it starts selling off here, you have to cut and run, right? Because this could immediately come all the way back down to 160s, and you're getting clobbered at that point, right? So just make note of that. This is more aggressive. You're not going in a lot of shares. In fact, take a pilot position or something, right? Be careful. But this does give you a chance to get some feedback on a potential leading stock that could continue and start another leg up. So it comes back down, shakes people out even more, now finally comes back up again. Take a look at the volume. So it's trying to take out that level again, trying to get also through that resistance area. And you'll see this a lot of times line up. They'll line up with a 50-day moving average, the Shakeout plus 3 kind of entry point, or a kind of a resistance area on the chart itself.
And Janet, I'm sorry, I see your question coming in. So this black dotted line there, the pattern recognition isn't picking up a double bottom yet because it's not finishing building the right side of the base. So what we're noticing here is the Shakeout plus 3 buy point. So that dotted line on your chart, that is going to be the area where you're looking to be engaged in the stock and find some of the portion of your stock. So that black line, that is going to be your initial entry point in the stock.
Yeah, and it looks like Doug's asking, best time to buy Shakeout plus 3 is when it's 5 points accompanied by big volume. Exactly. You need to have price and volume. Yeah, and I'd probably use that rule for any base, okay? So this is not really a base, it's just kind of an earlier entry point. It's more of a very aggressive point right here. But yeah, you want the volume. Try to put as many odds in your favor as possible. And so that's a huge point. Thanks for bringing that up. So yeah, that big volume coming through. Okay, so a lot of this does require chart reading, which is why we're emphasizing this does take experience. If you're new to this, don't go running around looking for Shakeout plus 3 buy points. But if you've been doing this for a while, if you really understand price and volume, now this is a place where you might want to consider just buying some shares. Okay, you're not buying a lot. I'm never going to go in and buy a lot of shares out of Shakeout plus 3 buy point. But I may buy a little bit just to get that feedback on a potential leading stock. And so then here's, eventually, you started seeing the buying really come in to CME, and then it had a super strong breakout at the normal kind of double bottom, and here's pattern recognition finally picking it up too. So if we go back to this one right here, you can see pattern recognition picking up as a consolidation because it's still very choppy and it hasn't really gotten that far up yet. That's what's cool about pattern recognition. There are a lot of rules that it's requiring for it to qualify as a double bottom, and then it finally qualifies probably a few days later after the Shakeout plus 3 buy point. And then so you get this huge volume and the normal thing. And so this is really kind of confirming, right? So once you got that volume, now the whole character of the stock has changed. People are happy to buy it again. And then you really get through the standard buy point. So say you got maybe a couple of percent of what you wanted to get at the Shakeout plus 3 or 5% of it, whatever. At least you get a little bit entry point here. You're up a little bit on the position. It may give you a little bit more confidence to buy a more of a normal position at the double bottom. Oh, it's another confirmation, the blue dot. Well, I mean, that's the blue dot right here is a confirmation that this is a strong stock now. The stock has become more of a leader in the market. It doesn't necessarily mean with the Shakeout plus 3, but a lot of times, even with the Shakeout plus 3, what you're looking at there is it's a bad market, and here's one of the stocks that is trying to resist the trend. It's showing a lot of power coming back. And so that falls into the concept of relative strength and all that. So and so in the end, now imagine this. You're looking at CME. Let me go back to this other slide first. You're looking at CME. It's breaking on at 220. and you're like, this has already gone on this monster run. Really, how much further can it go, right? So $220 stock. It's amazing at how some of these stocks, when everything lines up, when the market lines up, when the institutions truly love the stock, and when the business is just booming at that point, how far they can go. And it goes here you go, up to 500. So it's a double even from this point at $200. So never assume just because of the price that these stocks can't go up that much further. You really want to study this. And this Shakeout plus 3 is just a kind of another point in picking up strength in a stock. So Jason, let's go into trend lines and see how we can use MarketSmith to set us up for that.
Okay, Arusha. So now that you've seen it so far in this presentation, there's a couple more traditional approach of the Shakeout plus 3, and the last one, CME, some not traditional approach. Now we understand the concept. Let's go into MarketSmith and learn how to set the trendline price alerts so we can take advantage of these additional chart patterns. So when you first get into MarketSmith, it's just like going to be initial. So there's multiple different areas of where you want to click on a daily, draw a trend option on, you can reactivate them, and return. This is going to allow you to be alerted to stocks that you may not have had. The whole goal of it